we're not going to see it until it's here, and it's going to smack us in the face. Mm-hmm. And so being prepared is the best thing you could possibly do for yourself and your family. I mean, I would say...
Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
All right, welcome back to Loans Elevated. Thank you for joining us for another week. We have an update on the market, and in particular, what the Fed's meeting results were as of the most recent meeting in May, and what the following results were with the unemployment data, which is influential on what the Fed said and what their future actions might be. So we're excited to chat with you about this. We've got Ryan here on the show today, so welcome, Ryan.
Yep, pleasure to be back.
Yeah.
Always fun to chat.
For sure. So diving in, the Fed breakdown, I'll just kind of go over some bullet points of this, and then we can kind of pick it apart a little bit more. But the Fed left the rates unchanged. So rates have been sitting, the Fed funds rate between 5.25% and 5.5% for an effective rate. They didn't change that. There's been a lot of talk over the past maybe year or so about when will the Fed start reducing those rates. And the reason we've seen mortgage rates go up over that same period of time, or at least stay elevated, is because the data that's been coming out has not been supportive of them reducing it, which we'll dive into further. But one important note is they left it the same, and it's not a concern they didn't drop it this go around because it was widely expected, but an underlying concern the markets had was, is the Fed going to hike rates even further because of some of the deterioration in inflation data?
Month.
Yeah, over the past month or 6 weeks or whatever that we saw. And they did not hike, which was a welcome surprise to the markets and actually helped mortgage rates this week. There is one other detail, I guess two other details that are important to talk about, at least just touch on. Powell did mention unemployment or the employment data being an important factor in the decisions they'll make. If they see deterioration in the employment markets, they likely are going to be taking action. And then balance sheet reduction, which we talked about this a while back, but Ryan, maybe just share the importance of that piece, because it's a unique shift that not everybody understands how impactful it is.
Yeah, so I mean, I'll say a couple things first. It's pretty interesting how it seems like they've changed their mindset from being so inflation data focused to now just switching gears primarily to unemployment. So I wanted to hit on that because you just talked about that topic.
For sure. And it's interesting because Powell did reiterate that they don't expect a cut until they have more confidence that inflation's going towards their 2% target, which the crazy thing is, for those of you that don't track the market as closely as we do, that 2% target is an arbitrary target that was made up in a Fed meeting years ago. There's no fundamental purpose behind it. It's more of an arbitrary target. So it's crazy that they're still focused on that, but they have continued to kind of reinforce the point that it doesn't have to hit 2% for them to cut rates. It just they have to be confident that it is on its way to 2%. And unfortunately, like we saw over the past 6 weeks, basically every report was increasing. The rate of inflation, I mean, we have not seen deflation. We've still continually this whole entire time seen inflation. We've just seen what they call disinflation. So the rate of inflation has been slowing. But over the past 4 to 6 weeks, we saw the rate of inflation reverse course and start to tick back upwards, which is concerning.
Well, and what's interesting though is because it's an annualized number, I've looked at Trueflation multiple times, trueflation.com, anyone who's interested in getting real current data, trueflation.com says that we're at 2% and we've been there for a long time.
I think even lower than 2, right?
It's 1.93 from what I've been seeing the last couple months checking it. So, I mean, that's the concern, is that the Fed has always been driving from the rearview mirror, and that's the problem with the annualized data, is they've got lagging effects that are still propping up higher inflation today that might be 6 to 8 or longer months old. So it's not taking into account for what's happening today.
And what's crazy to me is that the Fed in 2024 with all of the data and all of the technology that can parse and aggregate that data into trustable information,
right?
Why we aren't leveraging that? Like, that's what trueflation is. It's just not the government's version of inflation. It's the true inflation rate. And it's like we need to shift gears, because the challenge is the Fed was late to react because they were looking at old data and they're like, oh, this is not going to be a big deal,
right.
annualized data. And now they're going to be late to cut, and it's probably going to drive us into a recession like we historically practically have always done, right? It's always been this late to react. So we see issues in the economy.
It's extreme one way or the other.
Right.
Extreme one way or the other.
But there is the data that's the legit data, trueflation,
right,
that's showing us we're there. So anyway.
Well, it's a good lead into the balance sheet reduction that you had mentioned, because in COVID, what really brought those historically low rates was the money printer. I mean, the Fed was quantitative easing, right? That's the term for it. So they were purchasing bonds. So they were eating up the supply. That was bringing yields down. And that's why you saw mortgage rates come to historical lows. And now the opposite has happened, because they have to reverse course. They have to sell all that supply back onto the market. They're not buying up as much. And we're seeing the opposite happen today. So it's one extreme or the other. You saw COVID, historic low rates. Now we're seeing what at one point it was 20-year highs in mortgage rates. So it's these same boom and bust cycles. But the big thing that he mentioned in this meeting was, and we had known this was coming, that they're going to slow their balance sheet reduction, meaning they're not going to continue to flood the market with as much inventory of treasuries and bonds.
As much supply, yeah. So they cut that. And the crazy thing is, just to maybe hit on quantitative easing, which is what we did during, after the Great Recession through COVID, there were a couple times they attempted to pause during the long period. There was many years between those two events. But quantitative easing, like Ryan was saying, essentially what happened is the Fed became a buyer of these assets that basically propped up the housing industry and artificially reduced mortgage rates. They were a buyer, but they're a buyer outside of natural market conditions.
It's a free market purchase. It should be, right? It should be manipulated just by the market.
Exactly. It should be like,
purchase it.
Do the banks think that this is a good investment? Are the market conditions supporting the fact that this is a good place for capital to be? If so, perfect. Let's drive down rates. And like there should be a more natural market flow, but they totally broke that system, which is crazy, because this is really the past 20 years is the first time ever in our economy this has actually happened. And it has worked, pull us out of the Great Recession and pull us out of COVID. But what is concerning is we don't know how that's going to impact the future. And if you look at the nation's debt, I mean, it is like, I read a report on social media the other day, or I saw a graph. It took us something like 80 years to accumulate $11 trillion in debt. And in the past, 2 or 3.
Mainly during COVID.
We've accumulated 11 trillion more. So 2 or 3 years is the equivalent. It was either 40 or 80 years, which I know is a big difference, but nonetheless.
Either way, a significant difference.
Outrageous. But anyway, now you go to quantitative tightening. Now what's happening is they are a unnatural, non-market driven seller of these assets, these bonds. And so now you're flooding the market with a supply of these bonds that are not of interest because rates are so high. The banks are trying to dump these bonds as well, and the failed banks have to dump these bonds to free up depositors' money so that the depositors don't lose.
Supply is just hitting like crazy, and that's what motivates any market or controls any market is supply and demand. If you've got a ton of bonds available, the price is going to be cheap, right? They want you to buy them, and the yields are going to go up. And that's what pushes mortgage rates up, and vice versa. So it's a problem, and I mean that's something that hasn't been discussed a ton in today's market with mortgage rates. A lot of people think there's just some magic wand where, we're just saying what the rate's going to be that day, and that's not the case. There's just so much that goes into what makes a mortgage rate.
And one other thing to put on that, which is not the Fed per se, but it's a little bit crazy and it's interesting. So they basically said they're going to slow the flow. They were selling $60 trillion in treasuries. They were allowing that to run off. So they were not repurchasing. They were allowing their balance sheet to be reduced and sell those treasuries as they matured. Now they're going to reduce that from $60 trillion 60 billion, forgive me, to 25 billion per month in treasuries that they're allowing to roll off. So it's a dramatic reduction. However, something that is on the other side is the U.S. Treasury Department, which is doing, they are doing refunding to help pay for the United States debt. They're issuing new treasuries that are probably going to gobble up the reduction that we saw that the Fed is announcing here. I think it's not so much of like, hey, we're going to slow down our quantitative tightening. I think it's, we have to do this because otherwise the Treasury won't be able to sell their new issues. Yeah. And if they can't sell their new issues, the United States can't pay its debts. So I think there are some details. The devil is in the details on this that are lurking. And it's like, there are bigger issues than we're seeing at the surface, which is, and I don't know how to feel about it, but I think those two things are in concert. I don't think they did it to necessarily support the market. I think they did it knowing that
they needed to.
The Treasury Secretary,
like
is going to be forced. Do that. But anyway, what else we got here? So
BLS.
But Powell did, and diving into BLS, let's dive into that. But what he did say, Jay Powell, on his Q&A session after the Fed minutes, he did get a question about if unemployment rate ticks up, is that going to be enough for the Fed to start cutting rates? And he specifically responded that said a couple of tenths of a percentage increase in the unemployment rate would not be enough to cause them to cut rates. In other words, start to free up the capital markets conditions. But a surprise would, he said. So, of course, that's indefinite. We don't know what that is. But a couple of tenths, we were at 3.8, would be maybe up to a 4% unemployment rate. Wouldn't shock the Fed. It's kind of what they're expecting.
Right.
And that's a good segue into the BLS because I have a feeling they probably knew what was coming, and his answer was choreographed, already knowing the data that was coming the next day because he came out on Tuesday or Wednesday, right? And then we got unemployment data today. So I guess a couple days later, I think he already knew what was coming.
And that's the point of their monetary policy too, is to force the job market to, essentially weaken significantly.
Yeah, they've got to slow the flow of cash, basically.
Yeah.
So now diving into the BLS, crazy thing is, Ryan, we'll let you dive into the details, but for finally, the first time in a long, long time, in well over a year, I don't know exactly how long, but 12, 15, 18 months, something like that, maybe longer, we actually saw a surprise to the markets where the unemployment data was worse than expected. Every time for basically the past minimum a year that we've been tracking this and looking at 18 months probably, the numbers have been blowout, out of the water. Like the expectations are one thing, and the employment job creations are dramatically better, and the unemployment rate keeps going down. Yet all we hear about as consumers is
we all talk about how many big
people.
One of some of the largest companies in the nation are losing jobs, laying off thousands of employees. That trucking company, one of the largest in the nation last year, when we saw that shut down, we were all talking as a team like, oh boy, like is this it? You know? Yeah. And even from then, it was like every job report that came in was unexpectedly strong, and it just doesn't make sense.
But there have been downward revisions every single time on the backside, which is these unexpectedly strong numbers, they will revise.
And they're
1
not
and 2 months later.
At that
they're not
point.
even looked at. Hardly any.
Right.
The only reason we know it is because we're so invested in understanding the data because it's our job. But anyway, it was a positive for the rate markets report on the jobs data that we got today, actually, that on all fronts, everything was better for markets, meaning unemployment was worse than expected, or employment data was worse than expected. So dive into the details.
Finally, job growth details. So the markets were expecting about 243,000 job creations in the most recent report as of last month, and we got 175. So that's a huge miss. I don't think that's as respected as it should be. That's
27% off.
That's huge because every report leading up to this has been 20% more than what the expectations were.
And that's what's crushed us on rates. Every single time we get these job reports, that's really what's driving rates. As of the past, 3, 4, 5 months, it's been jobs that's been driving the rates. And it's really because that's what's driving the expectation of the markets on what the Fed's going to do with rate cuts.
Just the economy in general. If more jobs are being created month over month, that is upward pressure on inflation down the road. Because if people are employed, they're making money, they're working their hours. They're going to be spending. And when people are spending when they shouldn't be, because that's the whole point of the Fed's monetary policy is to slow spending. I mean, they're going the opposite ways, and it's that friction. And that's why the markets, I think, we've gone through the most volatile times in history, because it's like 1 minute we're like, okay, maybe inflation's taken care of. Like maybe we're going to actually recover from this. And then we get a report like this, BLS from the last couple months. And it's like, okay, everyone's working. There are job creations that are exceeding expectations every month. Like, where is this economy headed? So today was huge. I mean,
a couple other points on that were supportive of what you just said, because the concern there is if there's more job creations and more money being earned within the economy, there's more spending, and then prices are going to keep going. A couple other interesting things that were good for us was average hourly earnings went down. They rose by 0.2%, which was 0.1% lower than expected. So that is good, because that's less wage inflation essentially. So all of this is kind of like leading indicators of what will the actual inflation do with consumer spending. That was good. Additionally, average hours worked came down another 0.1%.
Which is a big thing. Because it's like, who cares if you create 200,000 part-time jobs? Like people need full-time jobs to survive today.
So this is crazy that a lot of people probably won't know. And it's like, it shocks me. And sometimes we get jaded by these numbers, but the average hours worked for all employees in the United States, 34.3 hours per week is the average hours worked. That's insane to me. That means that the average worker is not even working a full-time 40-hour job.
In one of the most expensive times to live ever in history.
Which is insane. So I think that is really telling to, like, a lot of these jobs are part-time jobs, which are probably an underlying sign of more financial duress within the U.S. households than the government data or the media's announcements are leading on. Because if you're having to go get a part-time job or a second or third job, what have you,
it's not to go pay for a vacation.
Right.
I mean, you're not going to do that to go pay for a vacation.
You're trying to sustain life. Bills. Right, exactly.
Put food on the dinner table. It's to survive.
So I think there's some sneaky signs here, and a lot, and maybe we're like, the crazy thing is what I've been thinking about as we kind of get in these conversations. I'm like, man, I just didn't think, like, I'm generally an optimist. I'm an optimistic person. But from a market standpoint, I'm like, maybe I'm just a bear, because I think the market is going to hit a recession. And I keep saying that, and I keep identifying, parsing the data and saying, man, that's another point. That's another concern. That's another concern. But I just think honestly, I think there's so much boiling under the surface that so many people are not paying attention to. It's a little bit scary. And I think it's going to cause the Fed to go reverse course I think what's going to happen at this point, they're so far out of control looking at data that I don't think is really reliable, that they're not going to make any proactive changes to actually help us land, to create a soft landing or keep the economy going. Instead, the economy is going to keep going. It's going to appear like a soft landing until we hit the ground and endo and flip and roll. Like, it's going to be a tough situation, I think. I think they're just going to be too late, because all of these underlying things, and I don't know, they're way smarter than us.
I was about to say, I mean, people much smarter than us would agree. Like Jamie Dimon, I think.
Yeah, Jamie Dimon,
Chase, CEO, mentioned it's impossible for a soft landing. There's zero chance we have a soft landing with where we're at
crazy.
Right now.
That's the CEO of the largest bank in America.
Exactly.
Saying that there's no way we have a soft landing. In other words, he's saying we will for sure have a recession. And I think the further this goes and the longer we try to kick the can down the road, the harder we fall.
Yep.
Which is insane. So, a few episodes back, I don't know, this is a while back, but it's worth reiterating. Go find it. It's about preparing your finances for the unexpected. And if you're not proactively thinking about this stuff and recognizing that there is real risk in the economy, there's real risk in what the future holds for you and your family and your financial situation. Like, it's something you should be focusing on. And realtors and other business partners watching this, you should share this with your clients, because if we're not getting proactive, we're not tapping the equity, we're not refinancing and doing things that maybe are counterintuitive, if we're not getting the household budget in a good place, like, you are missing an opportunity right now, because my view is it's going to get ugly. This wasn't meant to be a doom and gloom episode, but I know that's my bet. One interesting thing that I want to dive on real quick is so going back to the job creation. So 175,000 created, which was below the expectations of 243,000. The prior 2 months on an aggregate basis were also revised lower. 1 month higher, 1 month dramatically lower. It netted to 22,000 fewer job creations in reality than was originally reported. So those reports the past 2 months were actually worse than they appeared to be on the headline. But here's the other crazy thing. We were talking about truflation. Another data point for employment is ADP, the payroll provider, and they provide their own job creation data. Well, their job creation said that there were 38,000 jobs created in the small business sector. So not the large businesses, which I think is fewer than 50 employees or something like that. 38,000 job creations in that sector. Well, as part of the Bureau of Labor Statistics, the government's data, saying we created 175,000 net jobs, including small and large businesses, they have this weird model that they use. So it's not actual data. It's just modeling. So essentially it's an Excel spreadsheet with formulas. And they're saying, well, we kind of think based on this trend and this trend and this trend, it probably resulted in this number of businesses failing, this number of new businesses opening. So these failed businesses lost employees, new businesses gained employees. It's a metric created just by guesstimates, essentially. And they indicate that added 363,000 jobs to the market. So if the birth-death model of the small businesses added supposedly 363,000 jobs, yet the net number was only 175,000 jobs, that means that large businesses lost 188,000, which is the true data.
Who employs most of the world?
Right.
The larger businesses.
Well, and there's a significant amount of employees employed by small businesses, but
Sure.
That means that the data that we have actual data on, not guesstimates, not this the modeling that they create the small businesses, they actually lost 188,000, negative 188,000 job creations. But the ADP data, that is real data, now it's obviously not every small business in the country, but the real data was not that small businesses created 363,000 jobs like the government's data said, but that small businesses only created 38,000 jobs. So if that was the case, we're talking net job losses if ADP's actual data was accurate and then the BLS actual data on the larger businesses, we're talking negative 150,000 job creations, meaning net 150,000 employees lost their job after the ones that gained their job. Like that's a big issue. And that's another one of those boiling points that it's like, is this data legit? And are we using technology to our advantage to actually
monthly
guide
too.
Right, that's in 1 month.
So annualize that, speaking of annualized data.
1.8 million job losses.
It's a lot of jobs.
2 million job losses.
Right.
Yeah. That's insane. So, I don't know. What are your closing remarks? What do you think?
I mean, I would say I think, as we've been hinting towards this entire episode, we're not going to see it until it's here, and it's going to smack us in the face. Mm-hmm. And so being prepared is the best thing you could possibly do for yourself and your family. I mean, I would say, kind of circling it back to the housing and mortgage market, mm-hmm. I'm very grateful that I am in a mortgage fixed payment right now, because people who are in rents and uncontrolled environments, who have little to no control on their finances, is much more difficult to weather the storm versus having equities, having fixed payments, having cash on the sidelines, as we always preach, is a huge deal. And that's why we continue to preach this to anyone who's looking to buy, and why you should look to fix your housing expense as soon as possible. It is your second largest expense outside of taxes.
Yep. It's big. So we would love, if you guys want more information on this, have any questions about this, want to have a conversation, want a consultation on how you can get your finances in check. If you're renting and your housing expenses are not fixed, like Ryan just said, and you want to find a way to figure out how do you get a more sustainable situation for you and or your family, please contact us. We're always here to help. Talking to us doesn't cost you a dime, and we would love to help guide you through this process or enlighten you on the details. We're watching this stuff. We're reading at least 2 market reports every single day, and we're only sharing market data with you like once or twice a month. So we're here for you if you want additional information on a more real-time basis. But thanks for tuning in, and we'll catch you next week.
Thank you for tuning in. For more industry insights, Follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.